The Bureau of Labor Statistics reported a slightly better than expected consumer price inflation report for February. Annual CPI, which is reported on a non-seasonally adjusted basis, was at 2.8%, down from 3% for the 12-month period ending in January 2025. Annual core CPI in February fell to 3.1% from 3.3% in the prior 12-month period ending in January 2025. The month-to-month increases in both CPI and core CPI were reported at 0.2%. That is a seasonally adjusted number. Both were below the consensus estimate of 0.3%. The CPI month-to-month increase from December to January was at 0.5%, and core CPI for that 2-month period was at 0.4%. So I would just average that month-to-month increase with the latest month-to-month increase to sort of get a picture of where things are headed. Stock investors had a slight positive reaction to this report, but the rally was mostly in some recently beaten up high multiple technology stocks. The Vanguard Value ETF, which I own, it has a symbol VTV, was down 45 cents per share, while its growth ETF, symbol VUG, which I do not own, was up $5.11 or 1.37%. Bond investors were not impressed with the better than expected CPI report, possibly more worried, at least for today, about what lies ahead than the stock investors. The 10-year Treasury rose 4 basis points to close at 4.32%, which is up from 4.16% as of the first trading day of this month, March 3rd, 2025. The current yield, however, is consistent with what I would describe as a normal 2% spread to the anticipated annual average CPI rate. One measure of that anticipated inflation rate, as I've discussed in many videos and in my blog, is the break-even inflation rate for the 10-year tip, which closed today at 2.33%. That is the annual average CPI rate for the buyer of the 10-year tip to break even with the buyer of the 10-year non-inflation protected Treasury that starts out with a significantly higher current yield. Normal in this context means a rate that is not being significantly influenced by a Fed monetary policy like quantitative easing. The Fed has the power to suppress the 10-year Treasury yield below the inflation rate and has done so over much of the past decade or so, and it had done so in the past after World War II, where inflation was very hot and the Fed was able to suppress the 10-year Treasury yield below 2.5%. So the February inflation report does not yet reflect the inflationary impacts of Trump's tariff taxes, and a month-to-month increase that is slightly lower than the last month-to-month increase does not yet indicate a trend reversal from the prior two month-to-month increases, which were high. Trump tariff taxes will place upward pressure on inflation, particularly in expensive items like new cars, heavy machinery and construction, all new manufactured products that use a significant amount of steel and aluminum, which today will be subject to Trump's tariff taxes of 25% on both aluminum and steel imports. Those kind of products, cars, heavy trucks, farm machinery, uh, new construction, they are all heavy users of aluminum and steel, and the price is going to go up, and domestic manufacturers will raise their prices because the tariff provides a umbrella for them to raise their prices. They may not raise it 25%, but they will raise their prices because of the higher prices that the importers uh, have to pay for imported aluminum and steel. One reason for the recent decline in CPI involves a major expense category called owner's equivalent rent that has been moving down. This, and I need to put air quotes on it, expense is weighted at close to 26.198% in CPI and attempts to measure, and I'm not kidding here, what a homeowner would pay to rent their home that they own. I built my home in 1982 where I now live and have yet to pay rent to myself. In other words, the single most important expense item in CPI is not an expense at all, since homeowners do not pay rent to themselves. It's just a fact. It is my understanding that major home improvements are not directly measured by CPI, since those costs are viewed by the Labor Department as an investment, not as an expense. It is possible that some of those increases in home improvement expenses, like the new roof I put on my house last year, much more expensive than the prior one, is captured in owner's equivalent rent, but I doubt that anyone alive can make an educated guess on the amount. As an investor, which is why I focus on economic data in between election cycles in any event, I'm mostly sitting in my bunker now waiting for incoming. There is too much uncertainty for me about the U.S. economy going forward and the chaos that is emanating out of Washington, on top of what I viewed as an overvalued stock market using traditional valuation measures. I have been profitably pairing some stock position into rallies, and my total realized gain this year is over $10,000 from stock sales or stock fund sales. There's been a lot of volatility in the bond-like stock sectors, stocks that I own in those sectors, and I have been pairing positions into rallies, and it's not uncommon now for many of these stocks to move up 3% or 4% one day and then give back all of their gains the next day or the day after that. I have been buying some utility first mortgage bonds that have coupons at 5% or higher maturing in the 2033 to 2035 range, where I can purchase a one bond lot at the best S price and at below par value. I bought a few today. I'm going to publish another video later today about the demonstrably false claims that Trump routinely makes about trade issues with Canada. That will come probably in late afternoon.